2025 has been a disappointing year for crypto, to say the least. We never got the alt season we expected. We never saw retail come back. ETH never even broke its all-time high. And many are left wondering just what happened. Well, in this video, we're going to break that down. Why does 2025 feel so different? What exactly happened? And what does this mean for 2026? If you're excited to learn more, like and subscribe down below, and let's hop in to today's video. Now, we are all frustrated at this point. I'm frustrated, you're probably frustrated, people you probably know are frustrated, and we're trying to find out why. Why does this cycle feel so different? Why haven't we had alt season yet? Why are we nuking now? Is the 4-year cycle over? None of this makes sense. What is going on? And so I want to break down kind of what I'm seeing and why I think this is happening. And I'm going to back it up, I think, with some pretty good evidence. So this is the first chart I want you to have a look at. This is the 4-year cycle. The 4-year cycle is basically liquidity injections. It's debt refinancing. Every 4.5 years, sovereign nations have to refinance debt. They do so by injecting liquidity. And so you can see the 4-year cycle represented here. You can see they pump liquidity in, they pull liquidity out. They pump it in, pull it out, pump it in, pull it out. We went down. This was COVID, okay? This was the COVID pump. This was the massive alt season, everything bubble that we saw because of COVID. This is irregular. When you compare it to the rest of these cycles here, this is an irregular thing. This is a massive amount of liquidity. And so what we saw was a bigger drawdown in liquidity following this. Normally in these other cycles over here, you see just a little bit of a pull down. You don't see anything crazy. Here we go all the way down below. We go as far down as we went up on these other cycles here. This had massive implications. I think inflation got up to 10% here in the States. That's 5 times the 2% target. And so what we saw as a result was a prolonged tightening phase from the Fed. I do not believe that the calendar date on the year creates bull markets or bear markets. What I believe creates bull and bear markets is central bank policy, liquidity injections, and economic expansion. And so as a result of this, the Fed had to keep interest rates high at 5.5%, very high interest rates for a very long time. We've been there for years now. And so what that resulted in was the longest sideways chop in the ISM that we've seen, 32 months now going on. The ISM stands for the Institute for Supply Management. This is how we measure the business cycle. And for those of you who are coming back here to the channel, this might be a refresher course for you. This measures the expansion and contraction of the economy. And when the ISM goes higher, we see Bitcoin dominance fall. We see ETH go higher. An increase in the business cycle is an increase in asset prices. And so, as a result of this massive liquidity that we saw, we had to see the Fed prolong their tightening phase. This delayed the injection of liquidity. This delayed the expansion of the economy. And it resulted in this right here, telling us the United States is not in a recession, but less than 20% of the population is in economic expansion. We have the top 10% of earners now contributing for half of all spending in the United States. What do you think that does to retail? What we basically can assume is that alt season never happened because retail never arrived. Why didn't retail show up? Because the American dream got crushed in these last few years because of this sideways chop in the ISM, because of this massive injection of liquidity. The Fed kept things tighter for longer. And if you ask me, I think now they're being a little bit political. That's kind of, different people will give you different takes on that. I think they are. I think they're setting monetary policy to spite the Trump admin at this point. Not exactly a great thing, but it is what it is. And so now that we're seeing them be as hawkish as they possibly can, look at the growth of Fed liquidity. They have refused to inject liquidity and help out markets or the bond market for that matter. Look at what happened in 2021. They injected all this liquidity, they brought it down, and they never really brought it back up. I mean, we're projected to go a little bit higher towards the back end of 2026, but right now, I mean, this is where we are. We're barely above the point at which they pulled all of it out to account for this. And so I believe that this contributed to a massive recession, that not a nominal GDP recession, but a labor market recession. You can see here 153,000 layoffs in October. That's the worst in 22 years. You can see ADP, weekly change in employment. We're losing 45,000 jobs. The labor market is struggling. The economy is in a recession. Nobody has any money. And so therefore we never saw that retail-driven speculative frenzy that really fuels alt season. And it's the same thing for equities as well. It's not unique to crypto. I mean, look, you can see S&P 500 and PMIs. It's the same thing. S&P 500 stock price index and US manufacturing PMI. Now, you say to yourself, but the stock market's been performing very well. We've seen crazy gains in these AI names, NVIDIA setting new all-time highs. If you look outside the Mag 7, if you look at a small cap index like the Russell 2000, you will see that they haven't really done much of anything. And so this is why the cycle feels so different, because we had massive liquidity injections due to COVID. And that actually I feel okay with that. You know, the fact that like a global world closing pandemic is the reason that the cycle has been interrupted or disrupted, I'm okay with that. It's not because institutions, it's not because any of these other reasons. Like a serious, like massive thing that only happens like once in 100, 150 years, that makes sense to me. I can live with that. So I have to ask myself, is this really the post-halving year of previous cycles? This feels more like a halving year. This feels more like a halving year because the Fed is still in quantitative tightening. The Fed is still pulling liquidity out of the system. And so follow this tightening phase. The Fed hikes rates, runs QT. Okay. They have a drain on liquidity. Okay. Then we start to see funding stress. This is when you saw, you might have seen on the timeline that, repo markets were struggling, that the Fed had to come in and inject liquidity and intervene. The Fed ending QT. The Fed ending QT in the final month of the post-halving year, that has never happened before. And so it makes sense to me that this cycle is different because monetary policy stayed much tighter for much longer because it had to, essentially. And now you could argue whether or not they're getting political, do with that what you will. But the reality is monetary policy, central bank policy, is a big driver of bull markets. I don't think it's just the calendar year. I don't think it's 4 years from the date to the end of this date. What the Fed is doing, what liquidity is doing, what the economy is doing is important. And I did a video, it was a pretty long one, our last video. I broke down the entire bull case for 2026. Check that out if you want to know why I think 2026 is so bullish. But this is the why. This is the why do we even need to think about 2026 being bullish? Because of this cycle disrupting thing. Massive COVID printing, monetary policy staying tighter for longer, the Fed just ending QT in the final month of post-halving year. And so this never happened. The ISM never happened. You can see if you look back through the years, we had a pretty consistent pace here with the ISM, kind of taking a small, maybe a 12, 15, 16 month break. 32 months we're stuck sideways. And now we're finally projected to go up to 56 on the ISM with about, 60, 63 kind of being the max. We're projected to get there by the middle of next year. These are some charts from Raul Paul and Julian Biddle over at Real Vision. And so their prediction that because financial conditions are easing, interest rates coming lower, money market funds having more money, that's the bond market. So as QT ends, the Fed stops taking money off the balance sheet, and therefore the bond market can function smoother because there's more liquidity. Equity markets likely to go higher as a result. I mean, we've seen the Mag 7 going higher, but the S&P 493 hasn't really done much. The US dollar now, I mean, this is important to talk about too. Look at what the dollar's done in the last month or so. We're all the way back up at 100. And look at what others has done as a result. It's come right down because financial conditions are tightening, because global liquidity is being drained. And so what we're looking at in 2026, I think, is the actual true post-halving year in the sense of the catalysts that we actually need to see in alt season to see a broadening out from the high caps down to the mid and low caps. That's where I think the magic happens. That's where I think the action happens, because we didn't see it this time because the Fed kept policy rates so high for so long. And that's evidenced in these charts. I mean, where did the problem start here? They started in 2022 and the Fed hiked rates to 5.5%. Where did the problem start here? Where did small business credit availability start to break down? Right when the Fed hiked rates to 5.5%. When did consumer stress index start to peak higher? Right around 2022, and the Fed started to hike in interest rates. Bankruptcy index, a straight line up since that 5.5%. Look at that, 22. That's the Fed hiking interest rates. Initial Fed rate increase up and to the right. This makes sense to me. This makes sense why we are where we are, because this isn't the post-halving year in terms of actual bullish catalysts. We're still in QT. We are in quantitative tightening right now. At the time of recording, we are in QT. That's significant. That's a significant thing. Actually, last cycle, Bitcoin dominance actually peaked when the Fed ended QT. The Fed ended QT, Bitcoin dominance fell down, it retested the high, and it fell off a cliff. That was after QT ended. We're ending QT now in about a week. So maybe next year is the post-halving year. Maybe this year was kind of a wash, just kind of a sideways chop. Maybe next year is the year that we've been promised. And again, if you look back to the video that I made the other day, I think I make a pretty compelling argument for that. And so this is where we're at. This is the reality that we have. I hope this makes sense to you. I hope this makes you feel at least a little bit better about where we are and why. Not that the bull market's canceled, not that the 4-year cycle dictates now we must sell off. It's that we never saw the bullish catalysts necessary that typically took place in a post-halving year to begin with. We've been in QT. The Fed's been hiking rates, and we have not seen an alt season or any kind of significant movement in crypto as a result. And if that's the case, I'm okay with that. I'm okay to be patient. I'm okay to stick around for a little bit longer because I know why this is happening. It's not a mystery to me. I'm not looking up at the stars and I'm not wondering what could have been. I'm wondering what may be in the future. And if you'd like to stay up to date with what may be in the future, you gotta like and subscribe down below. Leave me a comment. Let me know if you've learned anything. Does this make sense to you? Do you think this is the true post-halving year and next year we sell off? Or do you think the bullish catalysts have yet to emerge? You tell me. At any rate, thank you for being here. We'll see you in the next video.